Hello everyone. Today we will talk about fundamental analysis. What is fundamental analysis? Fundamental analysis is the study of stock market by means of candlestick patterns. Now, candlestick patterns came from actually Japan. There was a Japanese trader named as uh, Sokyu Muniasa Homa. He was in the mid 1700s. He was the richest rice trader. If he was there, his earnings would have been equivalent to 10 million US dollars. So he was known as the richest genius to understand the trading market. So he introduced these candlestick patterns. He used to write on a parchment paper every day's price action, what opening price, closing price. He used to write this on a paper, and he used to keep a long record of this, day-to-day record of this. And then when he died, he just wrote a small diary was found by his son, who read it, and in that the patterns were written, and there was a note which read that this should not be shown to anyone. The text should never be shown to anyone, no matter how close that person is to you. Not because I want to be the only rich man, but because the text may be misunderstood by people who will most likely make many mistakes. But the worst part is that the text can cause huge damage, and as a result will turn against us. I do not commend that anyone read this text, and it should remain a family secret. In particular, Sanpo, 3 methods. Sanpo means 3 methods. Is a very unique technique, and only a few people know it all over the world. If you sell or buy using only this method, you will achieve steady profit, build a fortune, and never make a loss. You should know what value this text has. Be careful and determine as to the secret that is contained in this text. Munihasa Homa. This was what he wrote. And then it was modernized by an American known as Steve Neeson. This American, he developed this further in the 1990s, I think so. If I'm not wrong, the 1990s. I think everybody knows what you mean by the market is bullish and what you mean by the market is bearish. Bullish means the stock market is moving upwards. The prices are rising. Bearish means it's coming down. In candlestick pattern, there are 2 candles which we have to see throughout. Green stands for bullish and the red stands for bearish. It's a rectangular shape. It will be rectangular in shape, which is known as the body. And you will find on both sides a small tail in some candles, which we call it as a wick. Now, most important thing what you have to understand here is there is a difference of open and close in both these candles. Just look at this slide very carefully. Stop the video for a second. Look at it very carefully. In the bullish candle, the open is from the bottom and close at the top. And in the bearish candle, the open is at the top and closes at the bottom. When the price is rising, it will go from bottom to up. And when the price is falling, it will come from the top to the bottom. So it's simple principle. As you see in the slide, this open and close, you have to look into this, how this open and close works. And the high always is the high, the low is always the low. So this is a very important factor which you have to observe. I think buying and selling don't need any introduction. Buying means you buy at one price and then you sell at a price which is higher. This is what you supposed to do, right? So if you buy something at 35 rupees and you sell it at 45 rupees, you get 10 rupees as profit. So that is what we call it as a buy. In the same way, you can even sell. The stock exchange allows you to sell that what is not in your hand. You don't have the share in your hand, but you sell it in the market. Let us assume that the share price is for 40 rupees. You sell it, and then when the share price reaches, when the market is going down, it reaches 35 rupees. You buy it. So exactly the opposite. And there also you have the opportunity of earning a margin of 10 rupees because you bought it, you sold it at 45 and you bought it at 35. So again that profit comes to you. This is something which the stock market allows you to do. So what is a stop loss? In today's market, you are allowed to put stop losses. When I used to trade in 90s, we were not allowed to do, there was no system as stop losses. Now as there is a system of stop losses, it's more good for people not to lose more money. You are allowed to put stop losses. Assume that you want to buy a share of 100 rupees and we buy a share for what? Making profit, right? So when we try to make profit, sometimes the market goes down. So if we buy something in 100, let us assume that we bought something in 100 and the market goes down all of a sudden. You don't want to have more losses than, let us say, 5 rupees. So you can put the stop loss at 95. And you can also put a target that I want to earn 115 rupees. So this opportunity is there in today's stock market that you can limit your losses. Earlier we did not have this opportunity, so it was a blind trading. So we used to sometimes lose tremendously. Here we have the opportunity that you can stop the losses. That I only want to, let us say I only want to lose 2 rupees. So I put a stop loss at 98 rupees. It will trigger and you will be out of the trade. So that is stop loss. So as you are allowed to put stop losses, you can trail these stop losses. What is trailing stop loss? You buy something at 55, you put the stop loss at 50, and then when the price reaches 65, you bring the stop loss to 60. When the price reaches 75 or 80, you put the stop loss again to 75 lesser, and you can trail it. So when you are losing, you are not losing actually, you will be winning anyway. So that is known as trailing stop loss. You can do that also. Once you learn stock market, you can do that also. You can trail your stop loss and make profit. In the same as in the graph shown. Just understand this graph. Take 2 minutes to understand this graph. You will understand it properly. What is trailing stop loss? So when you know all these things, how to trail stop losses and everything, you can very well know that the myth is stock market is risky, whereas investing stock market is not risky at all, because you have to do proper research, analyze, and then trade. But just blindly you cannot trade. Just by looking at some YouTube channels and etc. You cannot. You please don't do that trade. I don't recommend that. That is not the right way at all. There are many people who follow different strategies just by looking at YouTube and all, YouTube, Instagram channels or WhatsApp channels. That's not the right way to trade. But have a proper mentor who can really teach you each and everything, and then with certain strategies try to trade. It's not necessary that a strategy done by somebody is suiting you. So there are too many strategies in the market. Like people try to do one or two trade. They understand it's a small research what they do, and they introduce that strategy in YouTube and all, and people will lose money. So don't do that. Get a proper mentor by which you can learn the stock market and then trade in the stock market. I'll tell you 100% or 200% profit you will make. Stock market is not a loss-making industry. It's really, if you know it well, if you understand it well, if you know how to analyze and know the candlestick patterns and how to analyze the market, how to do the research. And doing research is not so complicated. It can be done very easily, but there are lots of tools and lots of websites which help you in this. A few websites, I will say, which help you in this. You have to go through that and do trading in the stock market. And I'm sure all the financial issues that you will be facing will never be there in your life anymore. So wait for my next video. I will bring really worthy for you people. I'll bring some very good video to make you understand further on each level. Thank you.